Hello, everyone, and welcome to another LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Kristian Kerr. We are here, Kristian, to celebrate the third anniversary of the bull market. So I don't know if you've got a party planned where you are, but I'm celebrating by having my kids home and just trying to actually concentrate and get some work done.
Yeah, it is a, quasi holiday, at least for the bond trading community, right?
Those bond guys, we know they don't work as hard.
It's very
So
true.
the equity folks, of course, are still here keeping the lights on. So enjoy your day off, Lawrence Gillum, our chief fixed income strategist. So here's our agenda. We'll do more than just talk about the third anniversary of the bull market. We're going to, of course, talk about what happened on Friday with the call it China tariff spat that drove stocks sharply lower Friday afternoon. And then in the week ahead, we don't really know what economic data we're going to get because of the shutdown. So we're going to talk about some alternative ways to get a feel for how the economy is doing. We're going to listen to Chair Powell this week, and we're going to hear from corporate America because third quarter earnings season starts in earnest. So starting with the recap, Kristian, I want to get your thoughts on Friday. You know, it's pretty clear what caused the sharp sell-off, and it was sharp. In fact, pretty much all of these losses that you see in the 5-day return column were Friday afternoon after President Trump threatened to ratchet tariffs up on China by an additional 100% above where they are now. I think effective date for that was November 10th, if I'm not mistaken. So, but putting aside what happened, what does that tell you about U.S.-China relations going forward? Do we have to think more critically about trade tensions, or can we just say, you know what, they'll get it worked out because tensions did ease over the weekend? We can just move on and focus on other things.
Yeah, I mean, I think it depends on the school of thought. I think there's a lot of people out there that just believe this is part of the negotiation process. Um, they're supposed to meet later in the month, and I think it's trying to get an upper hand, and if that's the case, then it probably isn't as big of a deal as the market may have made it out to be. But I think, just the fact that there was a bit of complacency, I think, in the market, particularly if you look at stuff like, implied correlation levels, which basically just tells you the market was saying that there's zero macro risk. So I think that was just a serve as a reminder that things aren't across the finish line yet with regards to any a real China trade deal. So I think that combined with just the mechanical flows that we ended up getting on Friday. And what I mean by that is, if you look at the combination of stuff like risk parity, vol control, CTA, kind of that cohort of the market. I mean, they're basically at 100 percentile, and they've gotten very, very long. So when you get that spike in volatility, they were kind of forced to de-risk a little bit. And I think that was primarily what drove it. Is if you look at kind of some of the other areas of the market, like retail was net to buy on the day, right? They've been a big driver of the move, particularly over the last month. So, it's that same thing we've been talking about. The position dynamic, I think, is very important, and especially at these levels with a near 40% rise off the lows when we got to that high. So I think we're getting a combination of a reminder that there's still kind of risk out there on trade, even though we've kind of wanted to forget about it. That combined with kind of this mechanical aspect of it, I think is what really drove it. And we'll see if later this week we get more kind of mechanical de-risking or not. I think a lot's going to depends on whether we see kind of higher levels of volatility at the index level. And remember that higher volatility can be both on the upside. So today's move of 1.7% as we talk, is another factor that could kind of add to potential de-risking, at least in a short-term standpoint.
Yeah, it's Monday afternoon, October 13th, as we're recording this, and we're getting about half, actually even more than half of the losses back
Yeah.
at this point on the de-escalation over the weekend. And it wasn't just Trump saying everything will be fine. And, we pretty much had to take Trump at his word when, he said, buy stocks, great opportunity. It was. When he talks about de-escalation, we tend to get de-escalation. And so in this case, he is talking about de-escalation. And then it was backed up by comments out of Chinese officials as well. So we'll probably get a de-escalation, or we already have, and the market clearly is buying into that. I think it's also interesting that coming into Friday, you had an AI theme-driven week, and then of course that was turned upside down, and so we had tech lead on the way down. Consumer discretionary is a very tariff-sensitive sector, so that was weak. Certainly financials were weak, but then today you're seeing really the 180-degree turn back to what the leaders were before tech sold off on Friday, right? So you've got tech leading, you've got consumer discretionary, either tariff sensitive or China sensitive sectors are big winners today. So how about on the international markets, Kristian? I know you follow those very closely. I mean, certainly the Asian markets have to catch up to what's going on in the US because they were closed, of course, before the Friday afternoon sell-off. Anything you've seen over the last 24, 48 hours in terms of international markets that you think is noteworthy? I think the hostage release is more
Yeah.
of a humanity story than a markets story. But certainly we're all celebrating those developments in the Middle East today.
Yeah, I mean, I guess China didn't get the memo that everything's all clear, right? Because they were, they were down quite a bit, after the apparent de-escalation and weren't able to get back into the green. So, not, I wouldn't say that's a major, red flag, but I think, you want to see how they react after this, move higher in the U.S. markets, because if they continue to kind of lag, that might be a signal that this isn't, in the rearview mirror just yet. That's kind of what I would just be focused on over the next, call it 24, 36 hours. But I would expect to see them, go well into the green if we are getting kind of a true de-escalation here.
Yeah, good point. Beyond that, I guess the next thing to watch is whether Trump meets with Xi in South Korea at the end of this month.
Yeah.
And that will allow them to hopefully strike some sort of a deal so tariffs on Chinese imports don't go to 140% or whatever. Also interesting that crude oil is below $60. Certainly oil doesn't like a US-China trade spat. Bond market's closed today, as we mentioned, but we got some nice gains in the bond market. And gold is at another all-time high today. So a lot of interesting things going on in the
As is silver.
as is silver. Yeah, silver's up even more than
Yeah.
gold today at last check, and gold was a big winner.
Yeah, I mean the gold thing's getting interesting. It's been just on a wild run here. I do wonder, some of this I think is structural, right? I think there's, a lot of gold moving in the United States, and there's talk that, kind of gold's got to move around the world here, and that's kind of what's driving it. So, kind of the physical part of the world where these metals are actually at is kind of driving a bit of this trade, I think. But it does make you wonder. You would think in a world where we're getting kind of a peace deal that would be bad for gold, generally speaking. So the fact that it's so big here does make me wonder what's really going on. But listen, it's been in a very strong uptrend, as is silver. So I think you can't overthink it either. There's obviously some other factors here driving that. There's been a huge increase in ETF demand for gold for gold and silver as they've been kind of in these big up moves. So maybe it's just a natural part of what we've been seeing here over the last few weeks.
Yeah, we continue to like precious metals, but up 40, 50% in a pretty short period of time makes you think that maybe some consolidation is needed there. The rise in dollar hasn't stopped precious metals, right? We got a over a 1% move in the dollar last week. Sold off on Friday, but it has been strong recently. We talked about that, Kristian, about how the dollar got so oversold and sentiment was so washed out that it would potentially have nowhere to go but up. And that's indeed what's happened.
Yeah, we went to that major support that we've been flagging for a while, right? Kind of that 96-ish area, and the dollar index held, actually kind of undercut it briefly, and then ever since then, pretty much have been trying to crawl higher. I would say the last time I was on one of these with, or I guess the Global Thursdays with Adam, and we were talking about how the dollar index has really struggled the last, call it 6 months. Anytime it's gotten back to the 100-day moving average, and it's through it now, and consolidating. So we'll see. I think if we can kind of get a leg above there, then it does maybe open up the doors for potential dollar rally here. So to your point, it'd be interesting to see how kind of the commodities and some of the other markets respond if we do kind of get kind of another leg higher here in the dollar. But yeah, I think the fact that we've kind of held that major support and are starting to see some upside progress is something to really watch closely. Because I think it does have a lot of kind of knock-on impacts to some of the other international markets that we're following closely here.
Yeah, the talk is more about whether AI is a bubble, which we don't think it necessarily is yet, rather than US exceptionalism is dead. Those are sort of in conflict with one another. And frankly, I'd rather talk about AI than whether the dollar is, losing its reserve currency status or anything like that, which certainly we don't believe it is. So thanks for that, Kristian. Let's go on to the main part of our presentation here about the anniversary of the bull market. We won't have a debate here and put everybody to sleep about whether it's a birthday or an anniversary, but the bull market did enter its fourth year. It's through its 3 years, and on Sunday, the 12th. And so, we can put this into historical perspective and also, use history to talk about how much longer this could go. And so we'll start with just this chart of the first 3 years. So it's been good. We've had, this doesn't include Friday, so call it like an 86% gain since the bull market began 3 years ago. And you see here on this chart, that compares very favorably to the average and the median bull market. This includes all bull markets since 1950. We got off to a slow start. In fact, we were well behind after year one. Year one of this bull was only up 21% in the S&P 500, and the average is 40. But this bull has caught up and surpassed the typical bull, up almost 90%. So, but that's history, right? This is also history. The bull market, as we all know, has been driven by tech stocks primarily, and the AI trend. In fact, it's not entirely a coincidence that ChatGPT was announced shortly after the bull began in October of 2022. The biggest 7 tech stocks are responsible for about half the gains. So that you see the tickers here: Alphabet, Amazon, Broadcom, Meta, Apple, Microsoft, and Nvidia. Nvidia by itself, 15% of the bull market's advance, the 3-year advance. It's really remarkable. 52% is the S&P 493, the rest of the market. So I'll ask you to weigh in on this, Kristian, but what this tells me is if these big techs stop working, then the bull market is going to really have to rely on the rest of the S&P, right, which we call the 493, to push us higher. So how worried are you about this concentration, and do you think we could see a broadening out?
Yeah, I mean, it's a good question. I think, historically, when you get to these types of levels of concentration in the index, it's not early cycle, right? Go back to, 29, mid 60s, Nifty 50.com, like you start to get really high levels of concentration towards the end of it. So I think that is, something I think we think about on a strategic basis. I don't think it really matters too much from a tactical standpoint, but it is something I think to to be thinking about, or I don't want to use the word worried, but kind of a thing that these are kind of late cycle dynamics when you get such high levels of concentration. I even saw today that we've never seen such concentration in just the top three names, right? Like 21% or just of the S&P is in just three Mag 7 names. So, those are things you just got to be just aware of that it's not an early cycle phenomenon. And I think, listen, where we're trading, what, like, a little over 22 and 22, around 22 times next year's earnings. I mean, it's tough to see how we're going to get the multiple expansion to kind of keep getting these types of returns we've been seeing. So to answer your question, Jeff, yeah, I think we are going to kind of see this thing continue. It's gonna need the 493 or the 490 to really start carrying the load here if it's a true kind of secular bull market, like I think the data suggests it might be.
It'd be nice if every stock was up 88% since since October of 2022, but that's just not how the world works, right? We live in a cap weighted world. So I'm totally with you that this suggests late cycle, but when you go back and look at history, there's always groups that are kind of leading the charge.
Of course. Yeah. Yeah. I think too, like
You know,
what makes this a little bit different than maybe the 90s is that, you've got a lot more private capital, right? We've seen, versus the early 2000s, basically the amount of publicly traded companies has been almost halved. And I think that's a direct result of the proliferation of private equity. So I think that changes the dynamic a little bit. But, I would argue if so much of this bull market has been driven by kind of the AI narrative, which, you pointed out, it basically all started, to gain traction after ChatGPT came out, then I think you're going to want to see kind of the productivity benefits of this starting to spread, right? So in theory, that would mean that, the companies in the 490 should start to benefit from this. I think, that's kind of the next iteration, the next phase of this would be to start seeing that. And I think that's where you could kind of get the next extension hires if you start seeing those benefits translate into the 490 saying, hey, we're starting to see, productivity rise, earnings, do a lot better because of the implication of all these AI technologies.
yeah, we've seen small caps have some days in the sun. We've seen healthcare generate some interest recently. So there are other areas that the market wants to try to push higher. We'll see, maybe earnings season will get the market a little more excited about some other areas, potentially industrials ahead of stimulus in 2026. Time will tell. But yes, we do have a fairly narrow driven bull market, and the AI theme is very important in terms of support and keeping this thing going. So this chart shows you average performance for bull markets by year. So this only shows bull markets that made it to year 4. So not all of the bull markets since 1950, but good number of them. And the average year 4 gain is actually almost 13%. That's better than the average year 3 gain. Even though we had a really strong year 3 this time, if you average all the year 3s, it's only up 6. So you might actually be looking at a little bit of a pickup, a little bit of a tailwind, if we follow this pattern. And year 4 could be certainly as good or better than year 3. The other thing I want to point out here is that virtually all of the year 3s made it to year 4 with more gains, right? Only in this 1949 bull market, which certainly neither of us remember, Kristian, although I'm a little closer to you than you are. The 1949 bull market made it to year 3 and then had a down 4th year. But since then, all the year 4s shown here in red saw gains, up 28, up 6, up 30, up 1, I'm rounding, up 13, up 13. So good chance that this bull market lasts 4 years and we get gains in year 4 based on this history. So what do you think, Kristian? Besides AI not, let's call it the AI theme breaking. Aside from that, what do you think are the keys to this bull having another year in it?
Yeah, I'd say I like to look at this stuff through the election cycle lens. right? Because it tends to dovetail. But historically speaking, um, when you get a new kind of administration coming in, it's really kind of into the midterms, you tend to do okay, and then it's kind of post midterm where you see the potential for correction. So I'm kind of leaning into that a little bit, where I can make the case the administration pivoted, beginning of the year. I think the markets or the markets were expecting Trump, 2.0 to be a carbon copy of 1.0, and then it clearly wasn't around the first quarter. And then in order to get the OBBA passed, we ended up kind of seeing him pivot back towards 1.0. So I think that's kind of somewhat midterm driven. So it's very difficult to see kind of, the administration being negative growth, negative, kind of weighing on market sentiment going into midterms. Like, obviously it benefits them to have the market strong into that. So, I would say just kind of taking a step back and looking at it from a historical lens, kind of the way you are here, Bookie, and maybe throwing in the election cycle dynamic. I would say it would be difficult to see kind of a real bear market materializing, before the midterms. That would be historically kind of less less normal. So really kind of my attention, or my fear of kind of seeing maybe a weaker market really stems from post midterm. So that's what, a year away, right? So that's kind of the way I'm thinking about it from a longer term point of view.
Yeah, and certainly the election ties into the dovish Fed narrative, right? Because we're going to get a more dovish Fed, certainly when all the Trump appointees come in. That means the Fed is not going to break this bull market with hikes. And by the way, we're probably not going to have a recession in 2026 because of all the stimulus coming in, right? Almost a 1% of GDP in stimulus coming in 2026 from the OBBBA that you referenced, Kristian. So that's just not an ingredient or not a formula for a recession. So as long as we don't get hit by some sort of exogenous shock, right? The tariff scare in April was an exogenous shock, I guess you could say. Obviously, the pandemic was an exogenous shock. As long as we don't get hit by something like that, very good chance that this economy grows through 2026, and the market doesn't really start to price in recession until 2027. That clears the way for a positive year four of this bull market. And by the way, I show this on this next chart. This is annualized performance of historical bull markets, and then how long they last. We're just talking about getting through year four. Well, as you can see here, most of these bulls get to year five, or a good chunk of them anyway. And the average is about 5 years. So I would argue there's a good chance this bull goes more than 5 years. Very hard to predict, of course. But if you assume we hit the average, you're talking about 2 more years in this bull. And the annualized returns, while they've been really strong, you saw that on that first bull market chart, how we're up at 88%, at least through the recent bull market peak over the 3 years. It's not really an outlier in terms of annualized returns. There's 23, 21, 26, 20, 19. So maybe we cool off a bit to come closer to sort of the average annualized return for a bull market. But based on this, I'd say the odds are good that this bull has more room to run.
Yeah, I mean, my only pushback here would be, how many of these bull markets did you have the Buffett indicator at extremes, right? So it's like trees don't grow to the sky. So I think that's where
PE
things,
ever in a bull market
yeah,
year four.
yeah, yeah. I mean, the Nasdaq, for example, is well through, percent of GDP that we were in the dot-com era. So that's where I kind of wonder, because yes, it's nice to look back at these things and look at the historicals, but every situation is a little bit different, and that's where I'm kind of wondering if we can go another 2 years in this with us at kind of valuation levels that are just frankly high, and that's my only real question mark. Not saying that it means that we have to see a correction, and again, it could be like we were just talking about, it could be driven by the kind of the 490 and the benefits kind of spreading to other parts of the economy. But just to play devil's advocate, I would say that that would be a little bit of a something I'd want to see is, how many of these markets were extended on some of these measures, and does that kind of change the potential outcome?
Yeah, absolutely great point. This doesn't mean that volatility is not kind of come at some point.
Yeah.
In fact, bringing back your election cycle, I think the average correction in a midterm year is 18%.
Yeah.
So, you're talking about the possibility of a continued bull market for several more years, possibly. No guarantee, but possibly, while you still have corrections. And we had a correction this year, but it wasn't enough to end the bull market. At least the way we interpret it, 20% close to close declines to start a bear. We got close, but we didn't quite get there. Similar to what we did in the late 90s, really close
Yeah.
to a bear market, but didn't actually trigger. And that's why you see this 1990 bull, 9+ years. Same thing with the 2009. We got close, I guess, in 2015 to ending that bull. 2009, but it ran another several years after that and ended up being the longest bull market in modern history. So we'll have ups and downs, of course. We always do, but the backdrop looks pretty good despite high valuations. And that's another reason to expect maybe not 23% annualized returns until this bull ends, but certainly something fairly close to that, I would argue. All right, good stuff. So that's the weekly market commentary for this week, which you can find on lpl.com under the research tab. Let's go to the week ahead, Kristian. This is going to be interesting because we start earnings season and we're flying a little bit blind because we don't have a lot of economic data because of the government shutdown. You could argue that Chairman Powell's comments maybe don't matter as much because he doesn't have as much data. I don't know. But point is, we just aren't going to have quite as much to go on in terms of traditional economic data. And we're going to have to listen more closely to corporate America and other sources. So what do you think is most interesting for investors to think about this week?
Yeah, I kind of wonder if that amplifies the impact of earnings season. Longer this shutdown goes on, we don't have the data, then we're going to be getting our color for what's going on with the economy from company management. So I wonder if it does amplify this. And listen, I think the last week of October, half the S&P is reporting, or will be at half the S&P haven't reported, and like 5 of the Mag 7 will be reporting. So that could be a pivotal moment here for markets, especially if we don't have data. I think it also kind of lends a little bit itself to kind of what Jeff Roach has been talking about, that it starts to market sort of focus more on the private data. That's all we have. I listen. I don't think it's to be that big of an influence for this week anyway, because I think it's about what we've experienced the last few days. These trade dynamics will be probably front and center until we get kind of any real clarity. So, that's kind of what I'm focused on here. I do wonder kind of if the Powell stuff, if he's able to give us anything that really matters, given that he doesn't really have any insight himself, given the lack of data.
Yeah, we know the Fed has a lot of critics, so I'm sure people are, talking about maybe it doesn't even matter because
Yeah.
secondary sources of the economy matter more than government data, which in many cases is lagged, or people don't think have a lot of credibility and all of that. So, frankly, as a fundamental analyst and strategist, I like listening to companies and hearing what they have to say. Given we have a lot of banks, when you listen to this, you'll hear from banks already because we get a bunch of them on Tuesday. Let's see, you've got what, JP Morgan, I think Goldman, who else? BlackRock, banks and asset managers, Citi, Wells Fargo. There's a number of big financials reporting Tuesday. So we'll get a little bit of information about the economy just from those few names. And then, of course, as we go through earnings season, we'll be looking for more insights, but I think based on the data that we have, the economic backdrop was pretty good in Q3, right? The City Economic Surprise Index made a little bit of a run, was very positive. Certainly the Atlanta Fed GDP Now tracker, very, very positive. Even just consensus forecasts of GDP growth in Q3, very positive. We know the labor market slowed, but when the economy grows, and by the way, in Q3, you had a weak dollar relative to last year's Q3, that is supportive. And we know the AI spending is coming through. You know, that's been half of earnings growth. It's probably going to be half of earnings growth again, or certainly pretty close to it. We know that spending has come through. Seems like there's an AI press release every day, you know, whether it's Oracle or Broadcom or OpenAI or whomever, right? So that spending's coming through. So it's going to be hard for corporate America to miss on earnings. And it's going to be hard for corporate America to give bad guidance broadly. So look for something in the low teens again, similar to last quarter on earnings growth, and look for estimates to hold up. Actually, I saw a survey of institutional investors recently. The question was, are estimates for 2026 going to go up or down during earnings season? It was 60-40 in favor of up. I actually voted down. I was part of the survey. I was part of the survey that said down. I think actually that tells me that there's a decent chance that they hold up.
Yeah.
Right. So estimates probably not going to come down much, if at all, because of that AI tailwind. So I think it's going to be a good. It's hard to know whether stocks are going to go up or down, Kristian, as a result of reports. But I think generally speaking, based on the numbers, it's going to be a solid earnings season.
That's a relatively low bar, right? I think.
Oh, for sure.
So that to me is always what I look at going in earnings season. What are the expectations, and they're again we're in got that low bar to get through, so it doesn't seem like it's going to take much to to surpass. Perhaps that's gamed a little bit these days, but it is what it is. So going into it, I'm kind of in your camp. It's difficult to see kind of this not being a decent earnings season just because it has been. So kind of in your camp here, bookie.
Well, if you weren't in my camp, you'd tell me, and I'll always welcome the debate. So CPI and PPI are coming out next week, it appears.
On paper.
On paper, right? Because I guess the White House called those people back in, or those organizations made the decision themselves, I don't know, to actually come back in and produce those reports despite the shutdown likely continuing into next week. I don't think we're going to get retail sales or claims or import-export prices or any of the housing data. I think it's all going to be pushed out. And I guess they'll just sort of backfill this data once the folks come back to work. By the way, speaking of the shutdown, it looks like the Trump administration has figured out a way to pay the military on October 15th by redirecting funds. So that is not as much of a pressure point to end the shutdown as it was previously thought. So it looks very likely, even though the Senate will be back this week, it'll be very hard for the shutdown to end this week. I hope it does. We all do, I think. But most likely this goes another week or maybe even a couple of weeks. So that'll be something else to watch in addition to the China situation. And Powell on Tuesday, and the 12% of the S&P that reports earnings. All right. Well, with that, we'll go ahead and wrap up. So thanks, Kristian, for jumping on this week. Really, really great stuff from you on the markets and the latest news here and what to watch in the week ahead. Again, everybody check out our weekly market commentary on the 3rd anniversary of the bull market. Thank you to Adam Turnquist for partnering up with me on that. Everybody have a great week, and we'll see you next time on LPL Market Signals. Take care.
Yeah. Bye.